A teacher, a taxi driver, and a trader walk into a coffee shop. The teacher says her heating bill is up 15%. The taxi driver says his fuel costs are up 20%. The trader says his investment portfolio is up 35%. The trader picks up the tab. The teacher and the taxi driver split the tip. That is not a punchline. That is the British economy for the last 5 years. And if you have ever wondered why doing everything right still feels like falling behind, this video is going to explain exactly why. Here is what we are going to cover. How money actually works in this country. Why the people at the top of the system seem to get rescued every time things go wrong. And what you can actually do about it. With real numbers, no conspiracy theories, and no advice to buy gold and move to a bunker. Just honest information, because the boring documents nobody reads are where the real story lives. Let me introduce you to someone. Call him Dave. Dave earns £42,000 a year, lives in the Midlands, does everything right. He saves 12% of his income every month. He has no credit card debt. He has 3 months of expenses in an easy access account. Dave thinks he is playing it safe. Dave is losing money every year, and he does not know it. And the reason why is the central idea behind everything in this video. Here is a metaphor I want you to hold on to. Imagine a card game, 8 players around a table. The dealer has a machine under the table that can print more chips whenever the game slows down. When things get quiet, the dealer prints more chips and passes them to the biggest players first. The big players bet bigger. The pot grows. The smaller players look around and think, wow, things are really moving. But every new chip makes all the existing chips worth slightly less. The small players are not losing chips. They are just watching their chips buy less and less. The dealer calls this monetary policy. The small players call it the cost of living. The big players do not call it anything. They are too busy buying second properties. Now you might be thinking, that sounds like something someone says on the internet at 2 a.m. before trying to sell you cryptocurrency. So let us talk about what actually happened. With real numbers, from public documents. Before 2020, the Bank of England held roughly £445 billion in assets on its balance sheet. Bonds, mostly. Government debt. Mortgage-backed securities. Then, the pandemic hit. The economy stopped almost overnight. And the Bank of England did what central banks do when things get bad. They turned on the tap. Through a program called quantitative easing, which sounds complicated, but just means buying assets. By creating new money, the Bank of England expanded its balance sheet to around £895 billion by 2021. That is roughly £450 billion of new money created in under 2 years. Now, here is the important question. Where did that money go? When the Bank of England buys assets, it does not buy them from Dave in the Midlands. It buys them from financial institutions, banks, pension funds, asset managers. Those institutions receive cash. And what do institutions do with cash? They invest it. They lend it. They buy assets that go up in value. Meanwhile, Dave is still saving 12% of his salary in a cash account, earning 1.5%, while inflation runs at 5%. He is losing 3.5% of his savings value every single year and feeling responsible about it. This is the first part of the cycle, and it has a name. Asset inflation. Let us look at what happened to house prices between 2020 and 2022. UK house prices rose by roughly 20% nationally in that period. In some areas, significantly more. If you already owned property, your net worth increased substantially without you doing a single thing. If you were saving for your first deposit, the goalposts just moved further away while your salary went up by 3%. Same story in financial markets. The FTSE 100 and global indices recovered from the pandemic crash and climbed significantly through 2021. People who owned investments got considerably wealthier. People who did not own investments got relatively poorer. Now, you might say, but inflation hurts everyone. Rich people pay more for groceries too. Technically true. But here is why that argument misses the point. If your net worth is £2 million and inflation increases your cost of living by £8,000 a year, but your assets appreciate by 8%, your net worth grew by £160,000. You are inconvenienced at worst. If your net worth is £8,000 and inflation increases your cost of living by £800 a year and your savings are earning less than inflation, you are falling behind every single month. The same economic event affects these two people in completely opposite ways. That is not an accident. That is how the system is designed to function. Now here is the second part of the cycle, the reversal. By mid-2022, UK inflation had hit over 11%, the highest in 4 decades. The Bank of England, which had spent 2 years creating money to prop up the economy, now had to do the opposite. They raised interest rates at the fastest pace in a generation. They began quantitative tightening, the reverse of quantitative easing. Gradually shrinking the balance sheet, they took chips off the table, and this created a different set of problems. Higher interest rates meant mortgages became dramatically more expensive overnight. People who had fixed-rate deals ending in 2023 suddenly faced monthly payments, hundreds of pounds higher than before. Businesses with debt found borrowing costs had doubled. The housing market slowed, consumer spending fell. The economy wobbled, and this is where the third part of the cycle kicks in. The quiet reversal of the reversal. Because central banks face an impossible problem. If they keep rates high to fight inflation, the economy slows. Unemployment rises, businesses fail, and eventually, a recession becomes hard to avoid. If they cut rates to protect the economy, inflation risks returning before it has been properly dealt with. Every decision trades one problem for another, and the incentives inside the system. Political pressure for growth, financial sector pressure for cheap borrowing, public pressure for lower mortgage rates, all push in the same direction. Toward easier money, lower rates, more liquidity. The path of least resistance is always more of what caused the problem in the first place. Now, here is the fourth part of the cycle that almost nobody talks about. Who gets rescued when things go wrong, and who does not? In 2008, the global financial system nearly collapsed because major banks had made catastrophic lending decisions. The response was one of the largest coordinated bailouts in history. Institutions that had taken enormous risks and profited from them were protected from the consequences of those risks. The logic was straightforward. These institutions were too large and too interconnected to be allowed to fail. If they went down, they would take enormous amounts of the broader economy with them. That logic is not wrong. But it creates a very specific incentive. If you are large enough, failure has a safety net. If you are small enough, you are on your own. Dave in the Midlands gets made redundant and cannot make his mortgage payments. The system tells Dave he should have had more savings. A major financial institution makes billions in poor decisions and faces collapse. The system finds the money to prevent it within days. This is not a conspiracy. It is just incentives. And understanding this incentive structure is more useful than being angry about it. So what does any of this mean for you practically? Let me give you some real numbers. Say you have £30,000 sitting in a cash savings account, earning 3.5%. That is £1,050 a year in interest. Before tax, if inflation averages 3% over the next decade, your real return is around 0.5%. After income tax on the interest, you are likely losing money in real terms. Now, say you invested that same £30,000 in a diversified global index fund inside a stocks and shares ESA. Historically, global stock markets have returned around 7 to 8% annually over the long term. After 10 years at 7%, your £30,000 becomes approximately £59,000. That is almost double, tax-free. Inside an ICA, the difference between those two outcomes is not about being clever. It is about understanding that cash sitting still loses the race to inflation over the long term, and that the system is not going to send you a warning when it happens. Here is the framework I want you to take away from this. Think of your financial life as two separate piles. Pile 1 is your labor, the money you earn by showing up and doing work active, dependent on you being there. Pile 2 is your capital, the money your money makes, passive, works whether you are there or not. The entire history of how wealth is built and lost can be summarized like this. Pile 1, your labor is consistently eroded by inflation, tax, and the rising cost of living. Pile 2, your capital compounds over time, benefits from asset price growth, and is treated more favorably by the tax system. People who understand this build wealth. People who do not spend their lives working harder in Pile 1 while Pile 2 sits empty. The most important financial shift you can make is moving money from Pile 1 into Pile 2 as early and as consistently as possible. Not speculation, not timing the market, not complex strategies, just owning assets that grow over time and letting compounding do what compounding does. Now, let me address the things people worry about. What if there is another crash? There will be. There always is. The question is, what you do when it happens. The people who lose money in crashes are not usually the people who owned investments. They are the people who owned investments and panicked and sold at the bottom. Markets have recovered from every single crash in modern history. Every one, including 2008, including the pandemic, including every recession in between. The risk is not owning investments during a crash. The risk is making permanent decisions during temporary panic. What about house prices falling? Possible, but over a 25-year mortgage, the direction of travel has historically been upward. Short-term volatility is not the same as long-term loss. What about inflation returning? Entirely possible. In fact, historically likely at some point. Which is exactly why sitting in cash is the wrong response. Assets, property, equities. Index funds have historically been the best long-term hedge against inflation because their value tends to rise alongside it. Here are 3 practical things you can do right now. First, understand your own cost of living. Inflation. The official figures are averages. Your personal inflation rate depends on what you spend money on. Work out what your life actually costs month to month, because you cannot respond to something you cannot measure. Second move, long-term savings out of cash. Anything you will not need for 5 years or more should not be sitting in a cash account, slowly losing real value. Open a stocks and shares, ISA. Choose a low-cost global index fund. Set up a monthly automatic payment, then leave it alone. The more boring your investment strategy, the better it tends to perform, because boring removes the temptation to tinker. Third, understand your time horizon for every pot of money you have. Money you need in the next 2 years. Keep it accessible and safe. Money you will not need for 10 or 20 years. Put it to work. The biggest financial mistake most people make is applying the wrong strategy to the wrong time horizon. Keeping retirement savings in cash because markets feel scary, or putting an emergency fund into volatile assets, chasing higher returns. Match the strategy to the timeline. Let me come back to the teacher, the taxi driver, and the trader. The teacher and the taxi driver understand the system now. They cannot change the rules of the card game. They cannot stop the dealer from having a printing press, but they can stop keeping all their chips in their pocket, where inflation quietly eats them. They can start building Pile 2. They can let time and compounding work for them the way it has always worked for the people at the top. The reset is coming. It always comes. It takes different forms: a rate cut, a new stimulus program, a policy shift with a name nobody has heard of yet. When it happens, the people who own assets will move forward. The people who do not will wonder what happened. You now know what happens. The question is what you do with that.